Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, December 4th, 2025. It is 10:30 a.m. Eastern Time. So I'm starting the video, so we're exactly 1 hour into the trading day. And what I'm going to do in this one is start out with just kind of a update on equity markets and what to watch for this week. I will touch on couple of things, a potential pattern I've noticed in the broad market. I'm going to cover that in this video. It's something new that I just picked up on the charts today. Reviewing those, economic calendar we're going to start out with here. And then time permitting, I'll do a brief update on Bitcoin, gold, silver, and GDX as well. Just kind of loop those in there. All right, so this is the biggest thing this month. Well, first of all, let's back up. This month is December. December, from my experience, is a very whippy, difficult to trade month. You have a lot of year-end position squaring, tax loss selling, window dressing, all of it, low volume due to the holidays between Thanksgiving and Christmas. A lot of folks off. So just I always try to throw that out there. So, me, typically, I'll keep things very light. Be honest, if it wasn't for this site, I'd probably just, take most of the month of December off. However, I'd keep it coming, post what I see every day. There are trading opportunities. And I just want to, again, bring that up, that you're going to see that, the increased volatility, increased, most likely false breakouts, breaks of support, breaks of resistance, bullish, bearish chart patterns. All right, let's dive into what's going on this week. So this is next week. This is the federal funds futures pricing in, as of now, an 87% chance, so almost a certainty that we're going to get another rate cut. And you can see, so right now, this is how you read it. The current target rate is 3.75 to 4%. And so the probability is it's going to be 3.5 to 3.75. That's a quarter point cut. That's how you read this chart. And with a 13%. So what's that? Recently, I think that was north of 90%. It really locked up. And, it's pretty much we're locked in. This Fed and the Fed for the last decade or so, one thing they do not do is surprise the markets. The Fed of yesteryear would occasionally do surprise rate cuts or hikes. This Fed, telegraphs the hell out of everything, they don't want to shock the market. They just want to, so, you count on the rate cut most likely. What could change it or, change the future trajectory? Usually when they're locked in like this, they're going to give you the cut, but then they can jawbone it the other way to maybe not expect additional cuts. But let's talk about that. We have the economic calendar, which you guys can access on the site. Go to the top menu, right side of the chart, click on resources, and then economic calendar. In there at the bottom of the first one that comes up, you have a link to this one. This is Econ a Day. So right here, this is what we're watching for. If anything has, any known variables have the potential to move the market this week, it most likely would be this one, personal income and outlays. And that's the PC, the Fed's preferred inflation gauges in here. And so we'll watch that. So they're looking at a month-over-month increase, consensus for a 0.3% month-over-month and a 2.8% year-over-year core. You can read the numbers yourself. Hopefully you can see that there. I guess I could do this for you. It makes it a little easier. So again, the problem with the Fed, they're coming off 15 plus year of excessive, artificially low interest rates, near zero, a lot of quantitative easing, and they were able to do so because inflation was pretty much non-existent, and defied a lot of economists that think, print enough money, you're going to get inflation. Well, they did, but what it was doing is offsetting. The financial crisis was up to that point in time, the biggest debt bubble pop in history. And so that was deflationary, and they were printing a lot of money to kind of offset that and whatever. That's kind of my take on it. And then finally, the inflation did set in when COVID hit. They hit the nuclear button. They went just from, they made what they did after 2008, during and after '08 look like, child's play. So either way, watch this. Now, something I've done for years on the site is what I call my real-time inflation indicator. It's not perfect. I'll acknowledge its shortcomings, and that's to watch a general commodity, broad-based commodity index or index tracking ETF like this one here. And so, commodities, although the raw commodities are not in the CPI, the Consumer Price Index, or I don't believe the PC, they are ultimately, they translate into inflationary forces if they go up. In other words, if a bushel of wheat, and coffee and corn and all these things and beef and eggs, they all go up. Let's just say, they, over a period of time, they double in price, go 50%, whatever it is. Ultimately, that's going to translate into the grocery store prices, which that is where they count inflation. They go and they look at a loaf of bread, not a bushel of wheat. And so ultimately, wheat can only go so high before those the producers are going to have to pass those costs along. So this is, and that is one of the biggest components of the Consumer Price Index. Housing's in there too. You can look at the Zillow, how home price index. You can look at all things like that. Obviously, I know they use owner's equivalent rent, not actual home prices, but home prices are only going to go up and down so much without rents following, or owner equivalent rent. Again, what the government uses to calculate that. So let's keep it simple here. I always say the commodities, because the home price index, it takes time to come out when there's a sale made, before it's recorded, before it's reflected in comps and everything else, and especially before it translates into, again, what the BLS is doing, looking at what's it, the BLS? I'm talking about the CPI. Sorry, I'm getting confused here. PCE, the Fed likes CPI, also CPI very much matters. And again, those things will ultimately, over time, affect prices. But what we know for fact, commodities, we can tick day by day, second by second. Broad-based commodity indexes are typically most heavily weighted in energy, which is crude oil, natural gas, heating oil, things like that. You have the grains and oil seeds, precious metals are in there, industrial metals, soft commodities, livestock. You can see these are some of the weightings over time here. So what I'm showing you here, and this is how I've done it in the past, this is the runaway inflation. This was when the Fed and Biden and everyone were in denial. That's when COVID hit, and they just, again, they hit the all-out nuclear button, printing money, spending money, sending money out to everybody, whether you needed it or not. Everybody got a check. Every business got a check, not literally, but metaphorically speaking. And that's what caused that inflation. This is where the Fed finally did that, rut-row. Oh, we missed that. And there's inflation. So, and then the inflation started to abate once they started hiking rates and putting things under control. However, this is where we're at now. So we've had this period which has allowed the stock market to come to all-time highs with the abating inflation, commodity prices falling. But and these boxes are just month to month. So in the past, I've played the game where I would guess whether the CPI would come in hot or cold or on track. Now you can see here, this is where everything bottomed. It really troughed right here, commodity prices. And they have clearly and unmistakable, you can't argue this is not a subjective measure. This is an uptrend by the strictest and most clean definition, higher highs and lower lows. So this is a big component of inflation that is not being reflected, I believe, in the current numbers. It will, again, for the reasons I stated. It's not month to month. You can look at this, but you can see we've really been surging up here. So I'm going to, if the numbers are anywhere near accurate, I'm going to predict, hotter inflation. And this is, and hopefully the Fed sees this and they realize you can only get so easy before you're going to reignite inflation. And again, they've done that by, cutting rates. Remember, they cut rates 3 times a year ago, and they've started again a new cutting cycle. And we're almost certainly going to get one next week. And this is no bueno for inflation. So that's that. You can see the trend here. Commodities clearly trending higher. And again, it's hard to nail it down month to month because this is only a small component, and really technically speaking, as I said, not an actual component of the reports that they use for, inflation, CPI, PC, things like that. But it will ultimately translate over in there. So I'll move on. Just wanted you to, share that with you. You can keep an eye on that, watch it. Now let's go to the markets. All right, so NQ, this is the 15-minute chart I've given you for active traders. There was our sell signal yesterday. We hit the first target for a quick 1% or so pop. Profit bounce is expected, as I stated in the post yesterday in the comment section. I expected any bounce to be relatively fleeting and minor, and it was. It was less than a 1% bounce off of T1. To that high there. Still very much a divergent high. Then we broke down below this 25,600-ish support. Ran at that level again. We're back testing it now. Provide an objective entry. Of course, as I've said repeatedly, somebody mentioned it today and I concurred. Yes, the financials. I keep, every video I've done for the past couple weeks, several weeks at least, I've been highlighting on the financials this very, 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 to me, significant support level. 51.32 is very good price support. It defines the recent trading range. It was reaction highs here. It was an all-time high right there. And it was also those very key 200-day moving averages. So it's a confluence of three different support levels. The 200s come in together, so we'll call that one, and then price support. So, so as I've been saying, this is the second largest sector in the S&P 500. So the stock market will only go down, quote unquote, so much without the financials following and breaking down. So I continue to maintain that. So whether this market's going to see new highs before year end or right after the first of the year, this will probably determine it. Typically, the pattern has been for years now. Once you get near the new highs, you put in a marginal new, as long as you still have negative divergence, which we absolutely will. This is your current line. You can draw it up here. If it's only a marginal, meaning slightly new high, higher high, you're still going to have negative divergence. And I have, the pretty high degree of confidence the same pattern will repeat. New highs followed by a correction, new highs followed by a correction. And the bigger this divergence gets, one of these little seemingly innocuous new high with a mild correction will likely morph into something much bigger, again, based on the technical projections, how things look especially on these long term. This is the weekly chart. Big divergence here. So that's it. That's bigger picture. So this is it. Just kind of like this. Here was a high. It was a divergent high. It had a correction after we punched out there, but then we made a marginal new, and that's the one that did the trick. So a lot like this, divergent high, big drop, ended with a divergent low, divergent high, big drop, divergent high, big drop here. Wash, rinse, repeat, guys. This is no guarantees to any of this stuff. It's just probabilities, and the probability says whether or not we make a marginal new high anytime soon, it will most likely fail. And then we're probably going to come down, and my projections would be at minimum to this uptrend line and this very, very, very good price support. So that gives you about a 22% downside with, in my opinion, minimal upside on the financials. But again, what you're seeing now is sector rotation. The financials are the second largest sector in the S&P 500 behind tech. Tech's the largest. So we've seen tech wobbling, a lot of dispersion, if you will, but on the returns between the big tech names. You saw, Meta was the first to buckle, and today it had a nice pop in pre-market. I almost threw it out to you as a short trade idea, but we've got, I'm focused on the Qs right now. This morning in pre-market, and now, right now, it hit the 200s. See, this one got the most oversold. It was, down. And that's, again, unusual. You're starting to see some of these big tech names crack 26% down off the highs. But look, we rallied back to, you have both the 200 days, simple and exponential. You even have the 50-day moving average in there. And then you have this price support level right here. Price resistance, big old gap. That's the bottom of that gap. So Big resistance for Meta. If it can power through there, yeah, maybe it'll backfill this gap. I doubt it. I can tell you it's an objective short entry now, here up to, but not up much above 682, with a stop somewhat above there. Okay, back to the markets. All right, so NQ, I already gave you that. That's the little 15-minute chart. As I said this morning, if it does play out as such, and we start getting down to this final short-term target for active traders, what that's going to do, that's let's measure it out here from today's high. That's going to be a drop of only about 4.3%. Again, active trader stuff, 15-minute chart. You're not looking for, high double-digit gains on a 15-minute chart. You're looking for usually single-digit gains, trades lasting a few days, a couple weeks. But that would give you on QQQ, if we drop, okay, let's go back to this. Where's my pop-up? There it is. That's going to take us down back to, at this point, close to my first target. Remember, this was breakdown, back test, secondary trendline back test, and all along been stating we have to take this out to open the door for a much bigger drop down to that next target. These are the key October 10th highs. They were successfully tested in both the S&P 500 and NASDAQ 100 recently. Even mentioned covering shorts there, going long off that low 2 weeks ago. And been scaling back in, but just mild short exposure. Like I told you, we got to take this out to make a case to get aggressively long. And the financials are going to have to break that support I just showed you as well, as I've been saying repeatedly. So those are the things that need to happen. We still, by the skin of our teeth, we're clinging on to this, but I've got a new pattern for you too, to share with you on the, especially on the S&P 500 and the Wilshire. But there's that potential head and shoulders pattern, and again, that second target would take us down for another test of the 200-day moving averages and nice price support if hit. So again, if the short-term charts play out as I showed you, then I will turn my focus back to this longer-term daily chart, maybe even the 60-minute charts. Speaking of 60s, here's the futures NQ. This was our last trade here, swing trade on this time frame down to T6. Right now, I've given it to you on the 15-minute chart, but there's that same. This is the bearish rising wedge on the 60-minute chart. Our negative divergence. No different than really this little wedge we shorted here, or this one that we shorted there. That was our sell signal. We nailed it that day. Hit the second and final target on that one, bounced, and that was it. Sixth and final target there. And so that would be what that would look like if that plays out. Now, let me show you. Let's step out the bigger picture. Here's the new pattern. Okay, so I can do S&P. I'll start with S&P 500. SPY. Everybody likes the SPY. To recap, what I've been highlighting on the S&P 500 daily chart is this, divergent high we have here, just like we had a divergent high there, and we went in a little sideways trading range, made a marginal, again, same pattern, slightly higher high, and that proved to be it, failed, then broke down below the trading range, then took out the 200s, back tested them, got rejected, and all that good stuff, right? So we were able to milk that down with near impunity by shorting on the 60-minute charts there at QQQ, and then we covered August 6th, hard cover all shorts, go hard long, day of the lows. And now we've just come full circle. This is negative divergence. You can see it here. Indicators making their lower highs and prices making higher highs. We had a break of this blue primary uptrend line right here. A breakdown and a back test. We hit this 652.83 support again. That's that key October 10th low that I said has to go. It's very significant support in my opinion. And when it does, it's going to be a very powerful technical event. Whether we do this first into, year end or Santa rally or early, first quarter or not. Sometimes all eyes see the pattern and everyone's expecting that marginal new high, and maybe the sellers step in early this time. That wouldn't surprise me either way. Again, coin toss odds, right, guys, really. But again, those odds will change fast if the levels that I've showed you, a minute ago, including the financials breakdown, then it's no longer coin toss odds. It's high probability. All right, so what's new? This. What is this? These are called megaphone patterns, aka broadening wedge patterns. So you see, it's a wedge that's broadening, getting wider as it goes. We had one back here. I've over the years we've traded a few of these. I don't see them often. We can go back here all the way into 2015, so we're a decade ago. This is just one of several trades we've done on the site. This is the criteria in what the pattern is. So when you recognize the pattern, and you can look it up, what you need to have is at least you want to see 3 reactions on one side of the wedge and at least 2 on the other, right? So there's a wedge. And so the strategy is, and you need an uptrend leading up to it, which we have already. And let me change my tool color real quick so you can see a little better. And then so the strategy is, once you have a fully mature broadening wedge pattern, you look for partial rise. And the strategy there is to wait for it to turn down and then short it. And then you can have a stop, a relatively tight stop. Once you see it fail to go up, when it's rallying off the bottom and it fails to go up the top, wait for that reversal. And then that's it. You have a short, and the pattern is going to break down below. And again, that was what I posted back in 2015. These are always time stamped, these charts, date stamped. This is October. Here, let me go to the one before it because I had them in backwards order. So this is September 24th. This is my prediction. This is how we traded it. My notes right there: to trade a partial rise into the ascending broadening top formation short as soon as it is apparent the prices have turned down and are heading back towards the bottom of the pattern, with stops placed slightly above the last reaction high, just like I told you. So you can see even back then I predicted we'd go up a little more and then turn down and then drop. And so that was September 24th. And then to fast forward, that was it. We went about exactly where I predicted, failed on the partial rise, and then we hit my third and final target right there. Nice trade, and that was on that one was based on a 60-minute time frame. I've done these on the daily as well, and I just wanted to point out, since I didn't catch it last time around, I just noticed it today. Actually, first noticed on the because I had so many lines drawn on my SPY chart, and then I went to a clean board of VTI, which is the Wilshire 5000, which is the same VTI. I'll get to that in 1 second. So that was it. There was your broadening wedge. You had your nice 2 tags on top, 1, 2, 3, 4 on the bottom, and you went up, failed to make it to the top, rallied, bounced off the 50, tried to get there again, failed at the same level, and that's all she wrote. Now, again, so we were already short based on the breakdown right here on the 60-minute charts of QQQ, swung it down, and so here's where we are today. So, as such, you have a nice, clean, plenty of reactions, a broadening wedge pattern. And so far, we've, that never hit the bottom. This is the first rally off the bottom. So basically, a lot like that head and shoulders pattern that I showed you as well, potential head and shoulders pattern. If we turn down here, now you can go up a little more and turn down, but this is usually the optimal point. That's how I projected it before. This is about where I usually see it turn down, about halfway up into the pattern, maybe a little bit more. And so if the market happens to stall out here, and again, I showed you what could be the catalyst, if it's, the hot PCE or anything else that happens, the Fed says or does next week. Again, and look, guys, I do this all day long. I point out potential patterns, and then sometimes they don't materialize. If we just keep going up, well, doesn't mean that, the next step is to look at the, that marginal new and still divergent high, and maybe that's where we drop from. I just wanted to point this out. And again, you can use this strategy right now. This is actionable information. If you want to make a case, you can make a case. If you see it turn down, now turn down to where? Well, you'd want to see probably these recent lows taken out. It's not much. And let me get to the small caps in a second, show you something else. And again, the financials are going to need to buckle, but that's it. You want to keep it very, very simple. As soon as you turn down, start to see us turn down, you can take a short with a stop somewhat above that high point right there. Once you've seen the turn come, the turn really hasn't come yet off this high. All right, so that's where, for example, back here, you would have then saw this rejection right here, this turn down. You would have shorted there and put a stop right there, and you would have milked a good part of that drop. And then VTI is the closest thing, I've covered this in the past, to the stock market. All right, we all look at and they quote the S&P 500. Those are the 500 largest companies in the U.S. It's a cap-weighted index, so you have a high weighting on the NVIDIA and Apple and those big names in the top mega FANG stocks or whatever you call them. But VTI, here, I'll read you the description. It is the Vanguard Total Stock Market ETF, seeks to track the investment performance of the CRSP U.S. Total Market Index, which represents approximately 100% of the investable U.S. stock market and includes large, mid, small, and micro cap stocks, right? So that's it. You got them all in here. So again, this is probably the best ETF if you want to say, what is the U.S. stock market doing? What are the small caps doing and the mid caps, not just the overweighted, we know what the large caps have done to the market. So there's the pattern I picked up on. I have it on this clean board here. It's going to look, the VTI is going to trade a lot like the S&P 500 because it's more diversified. And that was it. So you had your, boom, boom, boom. There's your broadening wedge. You failed here, tried at that level again. So even if you had shorted on that first failure there and your stop would have been here, it would have played out, right? And so this is very similar right now. And again, we'll see where we go from here. But that one, we didn't come off the bottom. This is the first move off the bottom. So that's it. There's your strategy, guys. The important thing is when I always try to remember, speak to the different time frames and the different, the magnitude or the expected move of each pattern. These are pretty much almost topping patterns, at least for big. They're not short-term stuff like I started the video, these 15-minute charts I gave you of NQ. Yesterday in the comment section under that NQ short-term trade setup, I gave you this right here. For the small caps, this is RTY small cap futures. They need to break 2467, and they never did. I gave it to you before they got there, tested it once more, and so that level needs to break too to bring the small caps down. Again, these are included in the total stock market. They just don't move the needle as much as the large caps do. All right, so still a level to watch, and at this point, in case I'm mad, I'll set an alert, and then that way, even if it happens outside regular trading hours, it'll give me an alert. Okay, that's it. That's the market. Those are the things I'm watching, and we'll see how if those patterns play out. IBIT, Bitcoin. Like I said, I covered this pretty much in detail yesterday. We're still stalling out at that first level. We haven't failed there yet. So, if they can pop that, then there's a good chance they go up to that next. That was T2. That was T1. That was T2. And like I said, I officially removed that target. It's still very, very much a potential target. It would be, you have the 200 days there. This is where Bitcoin lost the 200s, back tested. So, if you're bullish Bitcoin, it could be the move to new highs. Like I said, for all the reasons, it felt good to take profits Thursday before last, or was it last Thursday? Yeah, day after Thanksgiving. And, if we go up there, that would be an area I would be looking to most likely put on a pretty good short on Bitcoin. So that's it. There's not a lot of update because we're still at that same level we've been at. So let's move on. Finally, gold, silver, GDX. Gold on the daily chart, I still have this uptrend line where we're walking above. I gave you, where are my gold target? Oh yeah, we had based on the 60-minute chart. When we shorted gold right off the highs on that breakdown there, we hit my first, second, third target. Reversed a hair shy of T4. We had that positive, aka bullish divergence on this. This was the time frame we traded off of on the 60. Whether it's going to go down to that T5 zone, it's still up in the air. I think it depends largely on the US dollar, whether or not, and that's going to depend on what the Fed says next week. So the dollar and all these currencies are probably going to grind around. But here's what I can tell you definitively. So this was the bullish falling wedge at the bottom, that big purple trading range on UUP, the dollar ETF that I gave you. Broke out, hit my first target, hit it again, then we broke out, and which increases the odds we'll hit my second and final target. We put in this little wedge. This is a divergent high right here. We broke down from that wedge. I can tell you we're probably about at the measured target. You take the widest part of the wedge, which I've just done, add it to where it breaks down. It gives you a measured target, which take us a little back below 28, which is T1. Now, again, so if we can power on up, which is still my preferred scenario because we're still above. We took out T1, now we're back testing. We already back tested it once. That validated that. Remember, I've had this level here since down here. The fact we hit it, reverse, hit it again, reverse, and then broke out and back tested. These are additional validations of that support level. Former resistance, once broken, becomes support. So now, and again, if they took it under a little bit, wouldn't surprise me. That's what they do. They being the nefarious forces, the powers that be. They know where the stops are going to be, so they're going to try to hit as many stops as possible. Again, we'll see if it happens. So if this does happen, which again is still the scenario I'm leaning towards, that will most likely cause another leg down in the metals because of rising dollar. Gold, I showed you kind of a very meh, it's just been dead money for the last few months here, grinding around, consolidating. Bulls will say digesting the gains, ready for the next leg up. Maybe that's so. I honestly, I don't have a good read on gold at all. Silver and GDX, I told you they're looking a little more precarious from a technical perspective. Silver, we also shorted right here. I give you a sold target on the daily. We might have different targets on the 60-minute charts of the futures, but never reached that. What we did is we put a new but now divergent high. We did not have negative divergence. We were only overbought before. And then we're starting to come off there. We still need that divergence confirmed. What does that mean? It's just in my book, term I made up. I like to see, even though there's technically speaking, as most will call it, negative divergence, higher highs in prices, but lower highs in the indicators. I like to see the PPO make a bearish crossover. That means this blue line comes down and crosses that white signal line. That effectively puts in a lower high, and that's when I call it confirmed divergence. So if we can do that a little bit more, might confirm that divergence. Then if we break that trend line, that's probably going to take us down to this next uptrend line there, and then possibly that $39 level there. Or if the dollar continues to get, drop, and especially if it goes down below that trading range I talked about, that's really bearish stuff. And the current administration is all about printing money and easy rates and all that. We all know what Trump's vying for. So if they get their way, and we're going to be looking at a new Fed president, probably appointed in January or whenever. Obviously, Trump's going to appoint somebody that will bend to his will. And so we'll see. But again, if everyone thinks the market's going to do one thing or any security is going to do one thing and it does the other, that's a pretty powerful move in the markets because it catches a lot of people off guard. So again, we're not even close to breaking that now. If we do, then all I can say is that should be very bullish, or at least net bullish for gold, silver. And then finally, GDX. GDX also, like silver, has put in, it didn't make a new high, it made an equal high, but you have much lower highs on the indicators. That's still negative divergence. So GDX on the daily, I gave you 3 targets. The final one, this trend line in $67 level. We came close enough to it there that it might be enough to satisfy that level. But based on this divergence, we did not have that divergence. We started to diverge a little bit back then, but now we have bigger divergent high, and will so if GDX makes a marginal new high, it would just look like this, right? If that happens. So just something to watch. These were the targets I gave you on the 60-minute chart. Trend line was hit, then T2, T3, T4, and that was it. That was the final target I gave you, and all those were hit. This is just a potential final target, and that's still potential. need to see what happens with the dollar next week, guys. So just be careful. I know everybody's foaming at the mouth bullish. I mean, everyone. I'm even bear channels, bear blogs, whatever I visit, articles. Even those guys are just, I can't find a bear out there right now on the metals. It's a little dangerous sentiment wise. So again, we'll watch this. I just wanted to kind of update those developments for you, and that is it. Yep, let's wrap it up here. Get the video out to you guys. So we have those short-term sell signals on NQ today with the breakdown of that level. RTY, the small caps, have a little work to be done. They are also, keep in mind that it's not mere coincidence that the banks are holding up lately, and KRE, which is the regional bank sector ETF, and IWM moving near lockstep. There's a lot of regional banks in the small cap sector, ETF, IWM, and small cap futures. So we need this trend line to break, which I suspect it will. Remember, this was a high in the regionals. This is a lower high. We'll probably break this trend line, resume the downtrend. And then the small caps will follow suit. Bigger picture on IWM. I gave you that short-term chart. This is still an active trade. Still a stop on a weekly close above this level right here through 250, 250. There was our breakdown. We hit my first target. We bounced. We back tested the primary trend line, which was a sell signal that broke, got rejected, came down close to, reversed. Wait. Yeah, that's right. That was T1. This is T2, right? Yeah. Oh, yeah, that's S1, R1. And so that's it. So we need to get that next leg down. This is 244.87 is minor support. Probably aligns with what I gave you on the futures, RTY. Take that down. We should hit my next two targets. And then, again, if those are hit, a big if, whether it's December, sometime in the first quarter, if those are hit, it's going to increase the odds of my longer term swing targets that I've shared with you, or trend targets. Okay, I will wrap up here. This has been Randy Finney with Right Side of the Chart. Have a great day.